This episode is brought to you by Gnosis, building the open internet one block at a time. Gnosis was founded in 2015, and it's grown from one of Ethereum's earliest projects into a powerful ecosystem for open user-owned finance. Gnosis is also the team behind products that have become core to my business and that of so many others, like Safe and CowSwap. At the center is Gnosis Chain. It's a low-fee layer 1 with zero downtime in 7 years and secured by over 300,000 validators. It's the foundation for real-world financial applications like Gnosis Pay and Circles. All of this is governed by Gnosis DAO, a community-run organization where anyone with a GNO token can vote on updates, fund new projects, and even run a validator from home. So if you're building in Web3, or you're just curious about what financial freedom can look like, start exploring at gnosis.io. Welcome to Epicenter, the show which talks about the technologies, projects, and people driving decentralization and the blockchain revolution. I'm Sebastien Couture, and I'm here today with Benjamin, who's the founder of CAP. And CAP is a stablecoin protocol that has insured yield. Now, I know insurance can trigger some people, but we'll get into all of that and how the protocol actually insures its deposits and how it generates yields. We'll talk about the restaking component here, how it uses Symbiotic to secure the deposits and a whole bunch of other stuff. Hey, Benjamin, thanks for joining.
Thanks for having me, man. Super excited about this.
So you're currently in China. I'm curious, just what's your impression of what's your high level impression of China? Is it the first time you've been there, or
No, I've been to China many times. I speak Chinese, so I come every year to practice Chinese actually. And so this year I kind of combined my language practice with meeting some crypto people. But yeah, I love China. It's a wonderful place.
Did you live there for a while?
I studied here for a year in Beijing during college. Yeah.
And what's your sense of, because I think for like a lot of people in the West, it's kind of hard to put a finger on like what Chinese life is like. And I recently listened to this Lex Friedman episode with this woman who is like Chinese and sort of like a Chinese economic and policy expert. And she gave like I think like a really sort of like, she gave me sort of an eye-opening look on like what life in China is like, what people's aspirations are like how people sort of deal with the things that, you know, sort of in the West we see as like state control and sort of bad, right? Like that, but that people actually thrive in these conditions. Like what's your sense of like what life is like in China, and what are the biggest kind of misconceptions that people have about China?
Yeah, I mean, I think there's like the people that have been to China and the people that haven't. And other people that haven't have a very macro view of China. So like politics, economics, world power, like struggles, right? But I'm from a small country. I'm from Chile. From my point of view, China is the same as the US, right? They remind me very much of the US, like big country type of culture, with a lot of diversity, obviously a big economy. Um, I was just in the rural China last week or like early this week, which is, very different from Shanghai where I am right now. But they're miles ahead of everywhere else, man. Like all the cars are electric, super clean. It's very safe. The absorption of technology or the adoption of technology in everyday life, I think it's higher, at least consumer technology compared to the West, especially Europe, right? Like it's not even close. They don't use cash. They don't use cards. It's all like WeChat or Alipay. So it's the digitalization of the countries. It's already there. It's been there for many years.
Yeah, it's super impressive. I think like that's probably one of the things that I've not been to mainland China. Like I've been to Hong Kong, but like
Uh-huh.
adoption of technology, I think like in Asia is
Oh, it's
just
very
like
different. I think Hong Kong is
super
like
different.
it's amazing. I love Hong Kong. My first startup was in Hong Kong, but mainland China is it's a different thing. It's a different completely different place in my opinion. From from a living standard, obviously not from a political point of view.
Yeah, it's crazy how like being in Europe, and I don't want to make this all about this, but it's just interesting to kind of get your perspective on this. How like in recent years there's been kind of a reversal and a like rejection of technology almost in Europe, and I wonder if that has to do with the fact that like a lot of technology in Europe is owned and operated by U.S. companies. If it's more of a kind of geopolitical rejection than an actual technology rejection, but it is worrying to see like European people and European kind of political discourse be like super anti-technology. It's like it's just so weird.
Europe is
Yeah.
at least 40 years behind China. At least.
Yeah.
Like if you compare Berlin, oh my God, like they use cash. You don't know what elevators are. You know what I mean? Like electricity, like what's it called? The AC is not in most places. And then you come to like Shanghai. I just shared a elevator ride with a robot, that was delivering something to somebody in the hotel. So it's just like you really can't compare. I mean, love Germany, right? I actually came up with the idea of cap in Berlin, but no, man, it's just like crazy how different, and people really don't think about that because again, people's idea of China is very like macro,
Yeah.
about politics, about economics.
Cool. Well, let's set that subtopic aside.
You're gonna put a
But
clip of me like fudding Germany. It's fine.
yeah, we'll use that as a hot take clip. But
Yeah.
yeah, like what tell like we know you studied in Germany, or sorry, you studied in China, and you came up with the idea for cap in Germany. But what's your journey, and how did you end up here? Like, how did you end up in on a podcast talking about your your China journey and your founding of this company?
Life is crazy, right? Who knew we would be here together talking about cryptocurrencies in a podcast? No, so I mean, I've been in crypto for quite some time. I started, in the Hedera Hashcraft space, doing some infrastructure there.
Oh yeah, okay.
I started a stablecoin 4 or 5 years ago on Polygon, so been in the stablecoin space for a while, and then obviously most recently I started Cap about a year ago, a little over a year ago. And yeah, that's kind of my little short spiel about crypto.
What was the stablecoin project you were doing before?
Qidao, QIDAO.
Oh
It was
yeah.
like very very different, right? It's like at the height of DeFi summer, um, type of project. No fundraising, max allo to the community, airdropping strangers. I don't even know who owns the token. Like the largest whales is like random people. Um, but yeah, it was a wonderful project. It was the first cross-chain stablecoin.
Okay, and this was on Polygon.
Yeah, well, Polygon started, then Phantom, Avalanche. Before you had OFT or XRC, we invented this idea that um, the token, when you bridge it from different chains, should remain the same. It should be fungible. Before us, that wasn't the case, right? You would have Wormhole Avalanche USDC, or Layer Zero Wormhole Avalanche USDC Ethereum, or like some long string like that. And so you had some crazy pools on Solana, for example, with all the different versions.
So before the show, I was asking you about your hot take, and you said that you think that stablecoins are less safe than what people think they are. Can you expand on that? Why should people be worried about their stablecoins?
I mean, I wouldn't say you should be worried, but I do think you should be cautious about, where you put your money. Because what happens every cycle is that, we learn certain lessons about, what is safe and is not safe. But it's usually the people that get burned that actually retain the lessons. Because if you lose money, you really remember, these kind of lessons. If you don't lose money, or if you weren't there, then you don't know what to look for. And so there are a few things that are kind of being done again in this cycle that I'm worried about, that have been done in the past. For example, over trusting third-party bridges, right? Even though we have these token standards that's supposed to have minting limits, the minting limits are the size of the market cap of the tokens, right? So there's like not really any like protections there. When it comes to DeFi, we're rebuilding Celsius and and all these different like what's it called, like CDFI lending platforms that were building them on chain, and they didn't suddenly become safe, right? It's the same issue of unsecured lending to teams, but now we're doing it on chain, and I think that's very unsafe, and I'm worried about how that's going to end up. So yeah, in general, I just think we should be very cautious about money, because it's money in the end of the day. It's not a game, and people can get hurt.
So, we used to talk about stablecoins in three buckets, or at least, I think like around 2021, people would talk about stablecoins as like there was the algorithmic, the likes of
Over
Terra,
collateralized,
and
and
then
then
you
there's
had like sort of
centralized.
CDP,
Yeah.
over collateralized, and then centralized like USDC or something like that. Do you think those categories still stand today, or do you think that we're sort of finding new types of stable coins?
Yeah, I think that definitely one of those kind of died, or it's like not very big anymore. CDPs are not big anymore. I think in general, synthetic stable coins, at least in number, they're not that big, right? Like there's one big synthetic stablecoin right now that's extremely successful, and it's Ethena, right? Synthetic meaning is not fully backed by dollars; it's partially backed by other things that are not dollars. But by and large, most stablecoins today are eventually redeemable for the dollar, whether it be T-bills, etc. So yeah, CDPs have definitely gone down in size. Obviously, algorithmic ones are gone. So really now we find ourselves in a world where there's two main buckets, I think, where you have yield-bearing stablecoins, and there's many different kinds of yield-bearing stablecoins, and you have these like non-yield-bearing stablecoins that are backed by bank deposits, and they're Genius Act compliant, like PYUSD, like USDC, etc.
Why do you think the over collateralized model didn't work so well, right? Because I mean, like I think the starting principle of say something like MakerDAO was to have a highly decentralized stablecoin, and with no kind of like no USD collateral, or at least no reliance on centralized stablecoins as collateral. And I think for a lot of people in crypto that got into crypto as a rejection of the fiat system, that's like a very powerful idea. Today, like size maybe, in the top 5, but certainly a lot in the top 2, which is dominated by USDC and UST. And then we have projects like FX, right, that claim to be super decentralized, but I talked to them on the last episode, and it turns out that the dollar peg is actually it sort of relies on USDC. Yeah, why do you think those like haven't really taken off? And would do you think they should? Like, do you think there's a space for highly decentralized stablecoins that are over collateralized?
I mean, we have to acknowledge what the discourse is today in DeFi, right? In the last cycle, it was decentralization, right? How can we stay away from the traditional banking system? And this was largely due to how regulators viewed crypto. They did not want to engage with us. They were going after teams. And so you saw the rise of projects like Liquidity, which is arguably the only decentralized stablecoin, right, in crypto. Now it's different. What everybody cares about now? Institutions, 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 right? How can we partner with banks? How can we connect to the traditional finance system? And these TradFi guys, they don't want to play any games, right? They don't want a stable coin that's not backed by dollars, because that is risky. Objectively, is very risky, right? Because we're not the U.S. government. We can't print dollars, and so this kind of push to be compliant, or at least adjacent to TradFi, has pushed our whole industry to forget about decentralization and focus more on scalability.
You think the industry is really forgetting about decentralization?
Yeah, yeah. I mean, yeah. I mean, I not to sound like a Debbie Downer, but like for real, I think like people just don't they don't value it as much as they care about scalability, right? If you're looking at, centralized L2s, if you're looking at every single stablecoin that's coming out, right, is centralized in nature, either because of their collateral or because of the team's administrative power over, the protocols. We're no longer counting how many multi-sig signers there are on these multi-sigs. We're no longer worrying about time locks, right? The idea of fully open sourcing your code base is no longer the standard. So just as like a review of where we are as an industry, it's just factual to say that decentralization for DeFi protocols in general is not at all at the top of mind.
Do you think that's a positive development? And if that's the case, then why would we still call it DeFi? Like, what is the distinction
Yeah, I don't know
then?
why we still
Like, I
call
mean,
it DeFi.
is it just fintech with better tech? Is that like the direction we're going in, or like is there still some viability in the D part of Fi?
Well, I think blockchain is not just decentralization, right? There are many things about the blockchain that are good for finance. Composability is one that really comes to mind, right? Like a lot of people talk about rebuilding Swift. We already have it. Literally any chain in the world with tokens can be Swift, right? It's just send and receive between wallets, and there you go, it's done. And so, that's very powerful.
That's interesting. I've never
And
really
I don't think
heard
it's
it put
negative.
so
I
bluntly.
just think it's like it's part
Yeah.
of any industry, right? Like right now, AI probably is in like a moment of high romanticization of what you can do with AI. Whereas crypto, we've definitely gone through disillusionment, and now we're looking at mass adoption. And when you look at mass adoption, you have to get rid of the things that most people don't care about. You have to focus on the things that most people care about. And for us, boomers in crypto, that maybe we cared a lot about max decentralization in the past. If we want the world to use crypto, maybe we need to think about what everybody else cares about too.
What do you think is, like, if there's one thing that the industry needs to kind of maintain as a core principle when interacting with the TradFi world, or like traditional finance kind of regulated world? Like, what is the one property or the one thing that like we can't deviate from in order to remain successful and like have a future where this whole project has not been in vain?
Well, part of us maturing as an industry means that we're no longer um, sort of unified in values. We're definitely in a multipolar world um, within crypto, where different groups have different values, right? Things that they think we should keep. Personally, the group that I find myself in is that of safety. I really think that um, the transparency of smart contracts, the immutability of smart contracts can provide a lot of safety. And if we can maintain that, then we can make finance better than it is today.
I want to kind of come back to what you said earlier, where decentralization is less of a value that is like sort of not as coveted as it was perhaps previously, right? That we're moving more towards, we're moving away from the decentralized aspect of crypto. Do you think that, like, isn't it true that the infrastructure layers need to remain decentralized? Otherwise, they just kind of like, they're just databases, right? And I like this entire project has been kind of useless. We could have just built new data. We could just like done this on databases. Is there some amount of value, right? Like, is it like that maybe the higher layers of the stack are less decentralized, but the lower ends of the
Yeah,
stack are still pretty decentralized?
I'm talking about like DeFi. I'm talking about stable coins, right? Stable coins, DeFi. People don't care about decentralization as much as they used to. Um, for base layers, they do. And the writings on the wall. Who has the most stable coins in crypto? It's Ethereum, and nobody comes close, right? We've seen so many people try to make their own stablecoin chains for many years. There have been many, and they really haven't kicked off, right? The L2s don't have a lot of stablecoins at all. And it's because at scale, money's not dumb, right? At scale, people care about principal protection. And so that's why they're on Ethereum, using the applications on Ethereum. And some of those applications might be, less decentralized than we would want them to be, but at least, as you said, people care about the base infrastructure being decentralized.
Well, I think we'll come back to this maybe a little bit later, but let's talk about CAP's design. So, broadly speaking, there's different participants within the protocol. We have also sort of like different technical modules, different smart contract modules, and CAP utilizes restaking to ensure its deposits. So give us a high level, and maybe we can kind of drill down into the different parts.
Yeah, so CAP is a stablecoin protocol to generate yield for users in a way that we can, one, ensure the peg at all times, and two, we can protect users from the activities that must be done to generate yield, right? And the way that we do that is by two products. One is CUSD, which is a digital dollar. And this digital dollar, you can mint it with other stablecoins like USDC or money market funds like Benji and Biddle. What's great about that is, one, you don't need liquidity, right? Because at any point you can just redeem 100% of the market cap, no slippage, and then you're good. So you don't need to spend money on Curve or any sort of AMMs, which is quite nice for us. And it also means for users, they can leave whenever they want, right? They don't need to be worried about the peg. The other product that we build is the staked version of it, which generates yield. And this yield comes from two sources, primarily at the beginning from the base yield of each asset. So, for example, all the money market funds earn the US Treasuries yield. And then the stable coins, which are not allowed to share the yield because of Genius Act, we use some different strategy for each of them depending on their circumstance. For example, USDC, we put it on Aave because it's an over collateralized lending market. But that's not the exciting part. The exciting part is the other kind of source of yield. And we've built this sort of allocation engine where third parties, like regulated financial institutions or DeFi protocols, can compete with each other to generate yield for our protocol. And the way they do that is that they provision loans from our reserve and pay some sort of fee, right, in exchange for the loan. And they go off and they all execute their own strategy. So there could be 1,000, 10,000 of these kind of yield generators competing at one time to generate yield on the stablecoin. But we don't trust any of them. And so before they can come to our protocol and generate yield, they need to convince a restaker on Symbiotic or EigenLayer to vouch for them with their cryptocurrencies. And if the yield generator were to default and not pay back, we can slash whoever vouched for them. Yeah, I'll stop there. There's a lot you can go into, but that's the high level.
Yeah, that's great. Thanks. So there's two products. There's the CUSD, which is the non-year yield bearing stablecoin, and then you have stCUSD, which generates yield. Like, why would someone hold CUSD over USDC? What's fundamentally the difference?
Well, it's all about integrations, right? In a lot of integrations in DeFi, like perp dexes or pools, etc., you can't use yield bearing assets. You need a pegged asset. And so if you look at some of the larger yield bearing stablecoins today that have a staking kind of module, they all have lower than 70% staking rates. And that's because of these integrations.
Yeah, okay, that makes sense. And so if we just kind of recap here, so the user deposits some collateral, and in this case it's a stable coin, so USDC or USDT. That goes into the protocol, and then you have the operators that are hedge funds, primarily institutions that will use those coins to go and generate yield. So they're implementing their own strategy. And some of those might be implementing like super high risk strategies. Others may be implementing like lower risk strategies, but there's like a basket of strategies there. And then we have restakers that are acting essentially as the backstop, as the insurance fund for against those USDCs, like against
I would
those
say
deposits.
insurance fund is a very passive term. I would say they're sort of the decision makers. So instead of having a DAO say, we're going to put our money here, we're going to put our money there, restakers say, Susquehanna, you get to generate yield for cap on $10 million. Or Amber Group, you get to borrow 20 million to generate yield. And so they decide who gets to make yield. But in order to do that, they need to vouch for them. And so it's a bilateral relationship. It's not like I, as a restaker, I vouch for Wintermute, and now if Amber Group defaults, I'm getting slashed. I'm only exposed to whoever I vouch for. And why is that important? Because these yield generators, what do they want to do? It's not their money, so they want to generate as much yield as possible so that their spread is very high. Restakers, what do they want? Well, they want yield, right? Because Bitcoin and ETH don't make yield compared to the dollar. It's not even close. The cryptocurrencies are not productive assets like the dollar. And so they come to restaking land to get some sort of yield. They don't want to get slashed above all else. And so they're never going to underwrite extremely risky strategies or extremely risky third parties. And so that kind of balances out the system.
I don't know if you're familiar with this protocol. I mean, it's still like in the early phases of development. It's not released yet. They have like a website, but mezzanine, where they have like kind of risk tranching.
Yeah, the tranching stuff. Yeah, I mean, there's
so would it make sense to have like risk tranching here? So where you might have like low risk, right, where you're getting kind of like the treasury yield, and then maybe some higher risk, and then like some very high risk, and then that all those different sort of yield sources are being combined to provide the yield to the end user, but there is some amount of like kind of backstop where the higher tranches are protecting the lower tranches.
Yeah, so here's the thing. I don't think retail has the mind to be making these decisions. And so we abstract it away. You're right to say, we have all these strategies, but the dollar holders don't get any exposure to the risk, right? If you're holding stCUSD, you are not exposed to the risk of the strategies. Who is exposed is the restakers, right? And so it doesn't really matter. You don't have to tranche it, because what would you tranche? There's no risk to tranche. The tranching is on the other side, where restakers can choose like, hey, I am super risk averse, I'm EtherFi, so I'm only going to delegate to Bank of America, just to give you a random example. Or maybe I'm restaker XYZ and I want to get as much yield as possible. Let me delegate to a crypto native market maker, right? And so you'll have these different tranching on the other side. And it's important to keep it on the protocol or B2B side, all this tranching, because there's a lot of complexities, right? When EtherFi delegates to institution, they're not just trusting them, right? They're signing some legal paperwork on the side to arrange what will happen if they get slashed, et cetera, et cetera. Who is in a good position to sue Bank of America, right? It's not some, small farmer at all, right? It's these big projects that have raised millions of dollars. They're in a good position to sue. And so we're kind of shifting a lot of the burden of these decisions and management to the restakers. Obviously, not for nothing, right? They get more yield than ETH and Bitcoin have ever seen.
Okay, right. So the restakers have legal agreements with the operators, the market makers, the crypto private equity funds, etc. And those agreements lay out the types of strategies. Will have kind of like risk management provisions, etc. And the restakers are on the hook for those operators doing their job right.
Exactly. And the operators are on the hook to the restakers. So you could put it like this. The stablecoin holders are protected by smart contracts. They don't need to trust anybody. The restakers are protected by the law. And so then they should only delegate to good counterparties, right? Susquehanna may lose money sometimes. Like, everybody can lose money. But they are a good counterparty, right? If they owe you money, they'll pay you back, right? And so that reduces the risk for the restakers.
So what constitutes a slashing event then, and what's the flow of capital for end users to be made whole if like one of the operators loses all the money,
Yeah, so we are a completely on-chain platform. Everything's smart contracts. And so we don't really know if the borrower lost the money or not, right? What do we know? We know how much money they borrowed. and we know how much money they've been delegated. And so we track the collateral to debt ratio. So how much delegated value is compared to the amount of loans. And if that ratio falls below a certain threshold, then that's when we liquidate. Sort of how over collateralized lending markets track loans like Aave and Morpho.
Right. Okay. So I guess one way to look at it would be that it's under collateralized lending where the tranching happens between the operator and the restaker, and it's kind of like abstracted away from the end user.
Sort of, yeah. I mean, it's like it's a three-sided marketplace, which allows for, three different interpretations of the model, right? Depending on where you're looking at it from. From the point of view of the stablecoin holder, it's a miracle, right? You're having an over-collateralized lending market that's giving you 3 times the rate of Aave, right? And you're like, what's going on, right? And it's because you have this coincidence of wants and needs of these 3 different parties coming together.
Yeah, I love a good cow.
Yeah.
Coincidence of wants. Yeah, cool. Okay, so so who are the operators? Like practically speaking, who are you working with, and like what kind of strategies are they implementing? I mean, I guess like you don't know unless you're talking to them, which I suspect you are.
We know.
But, yeah.
We know because they tell us things, which is nice. So we launched a month ago, and for the first 2 weeks, we focused purely on setting up the reserve, right? Bootstrapping it with USDC. We got just over 100 million in organic user deposits from in USDC. And recently, we started onboarding the restakers and the operators. Now, in terms of the operators, there's ample demand for liquidity. Right now, there's a lot of market volatility. There are a lot of opportunities to make yield, and so demand for loans is pretty high. We have operators like Amber Group or like GSR, who are blue chip market makers in crypto. We also have Susquehanna, IMC, and Flow Traders, which are their counterparties in the TradFi world. These are huge enterprises, over 200 billion in AUM. So it's not just some random, companies that we've put together. And then finally, we also have some DeFi native names, right? Like Gauntlet, soon to have RE7 as well. So there's definitely a mix. And that's the goal, right? Because right now you have all these stable coins that are just making yields from treasuries or maybe basis trade. I can come to you and say, well, we're going to make yields from anything that the dollar can touch, because we can have a theoretically unlimited amount of operators to the extent that restakers are willing to underwrite a theoretically unlimited amount of operators.
Okay, so this is kind of like where the kind of like insured or covered loan component comes in, where like the restakers are covering the loan.
We look at it as guarantees.
Right. Okay. Has there been a slashing event? I mean, I guess you launched a month ago, but so I suspect not.
No, and we're going through great pains to make sure that there's no slashing events within at least the first year, because that would be bad, right? You don't want people get spooked for all sorts of reasons in crypto, and so at the beginning we are whitelisting who gets to borrow. So even though the final say is actually at the restaker level, Cap as a team can block certain people from borrowing, even if they have delegations. And this is because the last thing we want is for somebody to start up a restaking protocol and delegate to a meme coin trader and lose all their money and get slashed. Because then all the other restakers are going to look really bad and their users are going to start getting scared, like, oh, are we next? Even though, a meme coin trader has nothing to do with Susquehanna. It's completely different risk profile.
So which restaking protocols are you integrated with?
Right now, every single major restaking protocol is either delegating or is in the process of delegating to Cap. Some of them are faster than others. We're very happy with, Renzo as our first delegator on Symbiotic, and Concrete the next one. But then Stakestone and Hyperrhythm I've already delegated this week as well. So very happy with them. And obviously excited to work with all the other ones that are on the way.
Yeah, I know you guys are working with Symbiotic. Well, like, what's unique about Symbiotic that kind of like makes this all work as opposed to say like other protocols like Eigenlayer?
You have to be political here. Um, they're both great projects with great teams, and we are integrating both eventually. Right now, we're in audit for Eigenlayer, but we started with Symbiotic. We actually finished the code in Feb, and we've audited 5 times with like Trello Bits, Spearbit, Recon, Sherlock, a bunch of top tier auditors. Um, what do I like about Symbiotic? Well, it works, right? All the kind of features that we needed were live when we needed them, and so we were able to launch there. The team is very high quality. They know how to ship, and so everything kind of worked the way we wanted it to work. And then finally, obviously, the modularity is actually pretty interesting, because obviously cap is not the original intended use of restaking, right? It's not the original intended use case of shared security as a whole. One could argue is one of the best, in my opinion. But we can go into what I think about shared security later. Um, but yeah, that's why I like Symbiotic.
Yeah, what do you think about shared security? Like, what are the really valid use cases for shared security other than like this guarantee, this loan guarantee? Which I agree, I think is like a really cool implementation and like use case for restaking.
Yeah, I mean, I think it's interesting that when I read Eigenlayer's white paper, I saw universal a marketplace of trust, which I interpreted as you have people with money, which is ETH, right? And they have nothing to do with it because ETH doesn't have as many use cases as the dollar. And then you have people with skills, right? And there's some sort of trust economy where the people with money can guarantee the actions of the people with skills. But then in practice, everybody was starting to build these POS like networks where they were just validating off-chain data. And I thought to myself, why are we limiting this technology to just validating off-chain data? If you think about it, validating data is not a very high margin business, right? So can you really pay um, the high cost of shared security just to validate data? And the answer is no, right? Right now, these validation systems are generating $0 in fee, not a cent, not 10 cents. They're generating zero. And that's because, you have to constantly validate a state, but you don't constantly generate fees. And the only way to make up for that imbalance in the accounting is to issue incentives. And that's why Ethereum has inflation sometimes. That's why, Bitcoin gives a token, right? But the whole point of Eigenlayer and Symbiotic is that you don't need to have another token. And you just reuse the value of these tokens to have real value. But if you don't generate yield, then how do you pay, right? Anyways, so I was not very happy with most folks focusing on validating data, and I thought that we should really expand the use case of these guarantees to any sort of activity. It just so happened that I'm using it to allocate funds of the stablecoins collateral to generate yield, but it really can be anything.
Earlier when we were talking about kind of like decentralization and whether or not it continues to be relevant, do you think that this particular use case for restaking that is using a decentralized validator set and the assets that gain value due to that decentralization to secure or act as kind of like on-chain insurance, do you think that that's a use case that can grow and can kind of scale and become, the raison d'etre for restaking? Because like I agree, this whole like data validation like doesn't seem like a really good business long term.
Yeah, I think guarantees in general are definitely the way that restaking will survive and will thrive. Um, if you look at a lot of asset managers, bulge bracket banks, one thing that they really like about crypto is obviously the composability. The other part is smart contracts, right? Because a big problem in TradFi is having to trust other people. Trust is the biggest issue with finance. And so smart contracts can alleviate that. And organization systems like Symbiotic can alleviate that. And so I think there's ample PMF for it. And that's on like the demand side. On the supply side, in terms of like ETH and Bitcoin, these assets have a lot of value, and I don't think we're paying taxes in Bitcoin anytime soon. And so there's not going to be a lot of use cases for Bitcoin compared to the dollar. So this use case of restaking or using your assets to delegate to other people, I think it will have a lot of PMF for a long time.
So we touched on this a little bit, but you mentioned the Genius Act, and that some stablecoin projects were kind of like Genius Act compliant, and others probably won't be. What do you think will be the dividing line there? And for those projects that are Genius Act compliant, is it mostly then just kind of like having access to the U.S. traditional financial system, and maybe that's the dividing line between what we consider to be kind of like the degen projects and those that are not degen? Yeah, what's your kind of like long-term take on that?
Yeah, I mean, I think we definitely live in a multipolar world outside of crypto as well. So it's not the case that the U.S. says this is what we need to do and everybody does it. There will be folks that are not compliant, and they're just maybe putting their foundations in the Caymans and living in another country, and kind of like just not paying attention to American laws at all. Changing their UIs to block Americans so they can say we don't have to follow the laws. Cap is Our first round was with Susquehanna, and our last round was with Franklin Templeton, two great American institutions. There's no hiding from U.S. regulations, right? We're also American. And so the way we're going is the way of compliance, right? And if regulators have a problem with us, we're prepared to change things, right? And I think if you want to get big, if you want to be a large financial institution in the future from the landscape of crypto, complying with American regulations is key, because that's where all of the world's money lives.
Yeah, I agree. I think like this change in administration really has opened up the gates for a lot of capital to come into this space. And I think like a lot of people see it as like, oh, like this legitimizes crypto in the US, etc. But the offshoot of that is that there's just like potentially hundreds of billions of dollars that can flow into the ecosystem. And that's not going to happen probably not in places like Europe, where the political discourse is very different. Although I think there has been some departure a little bit, like at the E level from the CBDCs, now that they've seen kind of like what the Genius Act includes and what it can mean for US companies. There is a little bit, at least I've kind of seen on Twitter and stuff, some backtracking to something that looks more like the US system. Yeah, what are your thoughts on kind of like, you mentioned multipolarity, where you think things go from here if we look at like, the big poles, right? So like US, Europe, BRICS, and China.
Well, I'm not worried about Europe too much from a capital markets perspective. Most of these large institutions that are involved in crypto within Europe are invested in us. So IMC, Flow Traders, Edge Capital, Flowdesk, they're all not only investors in Cap, but they're also operators, meaning they are prepared to borrow and generate yield for a stablecoin protocol. And so that's all you need to see, right? The people that need to be involved are involved, and we'll have to see what regulators do about that. Obviously, there's nothing to say about South America, right? Because they're having fun. They use crypto. They don't care about, the tokens. They've been using stable coins for a while, and they'll continue to use stable coins in the future because they're a wonderful use case down there. Our job is going to be to try to tap into as many of these regions as possible. And the way that we're doing that is by accepting collateral assets that are integrated in each area. So, America will have the stable coins that are popular in America. Europe will have, the money market funds and the stable coins that are popular there. Our job for CUSD is to add all of that as collateral. So if you want to enter a yield system from Singapore, you can do that maybe through UOB. Or if you want to enter our system from Germany, maybe you can do it via Deutsche Bank's, money market fund. And so no matter where you are, Cap will be able to connect via these kind of integrations with the money market funds and with the stablecoins.
Yeah, I think my kind of high level view on the Europe US situation is that the US very early, I mean, even like I think US institutions, maybe the government, like the previous administration didn't see it this way, but at least like institutions saw crypto and stablecoins as like a technology that could improve composability, improve reliability, and security of the system, as like something that needed to be adopted by the industry, with the administration kind of giving that a green light. Now it feels like it's, full steam ahead. I think European banks and European financial institutions, at least like the more traditional ones, are more risk averse, and I think there's like regulators and policymakers are kind of sitting in this really uncomfortable position where pushing stable coins or the advancements of stable coins in Europe kind of undermines the power of traditional banks. And probably it will take a really long time for stablecoins to be kind of fully adopted in Europe. In the same way that Europe was kind of behind the US in terms of its adoption of e-commerce. Any technology in Europe just takes a long time because institutions have so much political power. And at the same time, I mean, not that they don't have political power in the US, but they're very risk averse. They're very adverse to change. They're very comfortable in their position. They're not pro
I
innovation.
mean, all traditional industries are,
True,
right?
but I think in Europe there's an even stronger sense of wanting to sort of like sit on your laurels and sit on your established uh, role, like position as an incumbent, which kind of informs policy.
Yeah, I don't wanna say too much about politics. Our
Yeah.
marketing person is gonna be looking at this interview and pulling their hair out.
So I wanted to maybe like let's just kind of do a thought experiment here, and let's kind of overlap stablecoins on the traditional finance system. Um, so if we look at kind of TradFi, right? Like let's take a country like France. Um, you know, the central bank, or at least the European central bank, like issues euros, flows down to the French central bank. The French central bank then lends those euros out to lends out those euros out to banks, right? Regulated banks, and and then those banks then like issue their own kind of stable coin, right? Their own version of the euro to depositors, right? To like their to their customers. And we have like you don't see it as a user of the system, but in reality you have like a Société Générale uh euro coin, and you have like an LCL stable coin, and like for Americans these bank names are not going to mean anything, but like you have the banks, right, like that are issuing their own version of the euro, and that's kind of abstracted away. But it works because you have this really good interoperability between all of these systems, because we have like kind of nationwide payment systems, and there's the backstop, and it's underwritten by the central bank, which itself is underwritten by like trusted institutions and their ability to lock people up, right? um, in crypto it's a little bit more complicated because um, we don't have this kind of like institutional backstop, and the interoperability is also there's sort of complexity in the interoperability aspect as well, where like your CUSD is not as fluently interoperable with any other stable coin because the risks are kind of like different. Do you kind of like see this parallel as kind of being relevant, and how do we get to a point where anybody can just be using any stable coin, and they're not kind of encumbered by um this problem that like the different risk profiles of the protocol introduces, where these different coins are not interoperable?
Yeah, I think it's a matter of like the design of the mechanism, right? Cap works with every single on ramper, off ramper, every single payment provider. every single bridge. Why? Because we're instantly redeemable for USDC, right? And you can, within our reserve, you can swap within all the tokens, right? Between the money market funds, between the different stable coins. So, you tell me there's an issue of interoperability, certainly not a cap, right? Because that's how we've designed the system. And you'll see that happen with larger companies like Coinbase, for example. They take PYUSD deposits as USD, just like they take USDC. And so it's just a matter of who trusts who. Cap trusts Franklin Templeton, and also they trust BlackRock. And so now we can act as like a bridge between them. Coinbase trusts Circle and they trust PayPal, so now they can act as a bridge between them. And so as long as you kind of grow this pie of trust, you can start seeing these connections. And it's very similar to the banking system, where overseas banks can connect to each other via this wire system that we have in TradFi, with the added benefit of how elegant crypto is, right, for organizing token transfers. But it's not a very difficult problem to solve. I just think we need is if you have a good design, then interoperability is pretty easy.
I want to like kind of zoom into this trust aspect, and this kind of circles back to what we were talking about earlier. Like, a lot of people in crypto got into crypto because of kind of this rejection of the fiat monetary system. So if you talk to kind of early Bitcoiners and like early Ethereum folks, like this idea that fiat, which actually the etymology of that word kind of comes from the word trust, right? It's a monetary system where you trust others. Crypto kind of felt like it was a rejection of that. I mean, it didn't feel like it was a rejection of that idea. And hearing you speak now, it sounds like you're talking like we're going back into kind of a trust-based system, but with one distinction is that because risk is now kind of spread across different restakers, different kind of funds, etc. In the case of cap, it creates a more opaque central kind of like authority to who is responsible, right? So it actually makes things more complicated for the end user who has like suffered some damages because of misconduct, right?
Well, it depends on how you do it. Like, for example, like with us, we take Benji, we take USDC as collateral, and you can track and see, these are the collaterals we take. It gets more complicated if, you're backed by ETH, but then you also put money in Aave, and then who knows where Aave is putting that money, and you have like these more complicated systems. And there are such stable coins where you don't really know where the money's being put. And so I agree with you that the question of, okay, I lost money, whose fault was it, will become more complicated when you have these stable coins that are kind of acting like hedge funds and putting their money in all sorts of places. But it's certainly not the case of cap, because we're all DeFi PTSD survivors, and we've built cap in a way that you're able to track what you've just described, right? Who is responsible for maintaining the quality of the collateral.
I guess it's not a reflection on cap, but just kind of like as the for the industry as a whole. So where the risk is more spread, perhaps it means that
The chances of something happening.
the chance of something happening is reduced, but
Well, it's increased, but it's like the penalty of it happening is lower.
the penalty may be less, right? But also like the crypto world operates in a space where there is a lot of opacity around like where operators are situated, and certainly like I think regulation kind of like help with that, where there may be like clear paths to litigation when that happens, but
Yeah.
it
I mean, look at what happened to Multi-Chain, the bridge. They got hacked by the Chinese government, or like a local government, and all the money got stolen. So Binance froze it, Circle froze it, Tether froze it. They haven't returned a penny to users. And the Phantom Foundation has been suing Binance and all these teams to give the money back, and they've refused to do it. And they haven't been able to get the money back because, that's just how regulations are. And so you're right. I think, and that's kind of why we built Cap the way we built it, because I really just don't think that users are in a place to get any sort of recourse. If your favorite yield-bearing stablecoin, the PEGs, you're going to be suing some random Cayman entity, right, with a director who's the same director for every other Cayman entity in crypto, and you're going to find yourself without a nickel of recourse.
Yeah, I think this is where like regulation will play a huge role, is where these entities need to be kind of like local in their jurisdictions where they're situated, and where they become highly sort of entangled with the traditional finance system, central banks, etc. But I think we're like really long way until that happens.
Yeah, that's
If
why
this vision of
you have to choose, like, do you want to trust the government, or do you want to trust smart contracts? And I think any project that's in the middle, where you're not trusting smart contracts, you're not trusting the government, you're actually trusting some random developer team, I am very scared of those projects. Because I know I can trust the government somehow a little bit, and I know I can definitely trust smart contracts. I know darn well I can't trust random developer teams.
Yeah, well, some people would definitely not agree with you that you can trust the government a little bit, but
Well,
that's a conversation for
I'll
another.
trust, like, regulators more than I trust a random, startup in general.
Yeah, yeah. I think some people might not agree with that, but
Yeah, obviously, yeah.
I guess like where the kind of proliferation of stablecoins does excel is offering these different trust assumptions. So you have like stablecoins that are fully centralized, where you don't have to trust anyone, and then you have stablecoins that are fully centralized, and then you have like sort of things in between where you're relying on centralized stablecoin deposits, but those deposits are backed by a decentralized asset. In the case of Cap, right? So like you're backing you're backing the centralized stablecoin deposit in the form of USDC, USDT with an insurance or a guarantee that is secured by a decentralized asset. And that might be like the middle ground that we need to scale, but then also remain decentralized.
How could I disagree with such a beautiful explanation?
Well, Benjamin, thanks for coming on. Anything you want to share before we wrap up?
Nothing. I actually, I would say that, a lot of people have said recently that the stablecoin space is extremely crowded and there are too many stablecoins, but I think they're wrong. I think there are not that many stablecoins that are differentiated in crypto. And so if you are, a founder that's trying to make a new stablecoin, make it. I want there to be 100 new stablecoins, 1,000 new stablecoins, because the more innovation that happens, the more liquidity we're going to get on chain, and that will benefit everybody. Because it's much easier to convince somebody that's using another stablecoin to use yours than it is for you to convince somebody that has money in like Bank of America to use your stablecoin. And so, yeah, I would have a call to not be discouraged by how many stablecoins there are in crypto.
Cool. Well, thanks for coming on. Enjoy the rest of your time in China, and good luck with this.
Thank you.